Hi, my name is Paul, and in this video, I'm going to be covering MTY Food Group's 2023 third quarter financial results and conference call. Then I'll briefly discuss what I think about the current stock price and whether or not I'm planning on investing more after this quarter's earnings. To give you a brief summary of MTY Food Group's business, MTY is a Canadian company that trades on the Toronto Stock Exchange under the ticker symbol MTY. The company owns about 90 different fast food and casual dining restaurant brands throughout the US, Canada, and abroad, and their main business model involves franchising out these brands. However, the company also operates a small portion of particularly profitable locations, and they also offer retail food products centered around their more popular restaurant banners in select grocery and convenience stores. So when I go through an earnings report, I'm usually looking to go for the management discussion and analysis version of the report, since that has added commentary by the management which helps to contextualize the results. And recently, MTY actually made the decision to start releasing this version of the report on their own investor relations page. So you don't have to fiddle with Cedar's recently revamped filing website, which is now much sleeker looking, but a bit of a nightmare to navigate. Anyway, opening up the MD&A report, let's take a look at the revenues. This quarter, the Canadian revenues increased moderately across the board when compared to Q3 of last year, and the US revenue comps are still massively higher due to the take-in of several franchise and corporate stores from the Barbecue Holdings Group and Wetzel's Pretzels acquisitions that happened within the last 12 months. Focusing in on the drop in food processing, distribution, and retail within the US, this was noted in the conference call as having to do with losing a key licensing agreement and it taking a bit longer to relist and relaunch those products. In addition to that, the Canadian growth in this segment of only 3% was also brought up in the call. And if you followed my coverage in the past, you'd know that for me, this is one of the really promising growth vectors for the company going forwards. And it certainly is at the very least a bit of a bad sign to see that the growth rate has dropped to the low single-digit range. So this needed an explanation, and we did get one, but it was along the lines of, we see a lot of promise in the segment, and we expect things will get better. See, the management stated that things are slow right now in Canada because the grocers are still heavily pushing their own branded labels and bundle deals, with less promotion being directed towards private labels. Meanwhile, in the current economic environment, customers appear to be bifurcating towards either the more discounted products or the higher end products, which is good news for some of MTY's more premium products, though sales volume for a lot of the more mid-cost range offerings are fairly stagnant. Still, aside from the announcement that there are some new retail products in the works, likely associated with the newly acquired brands, we didn't get much in terms of outlook, aside from that the management is projecting positive future quarters. So yeah, the retail and distribution growth is looking pretty questionable at this time, and I don't know how likely grocers are to start pushing private label brands. I also don't know if or when consumers will return to regularly purchasing more middle-end retail products, and I don't know how the new products will perform. So the retail segment is kind of up in the air at the moment, and I definitely won't be counting on it making a recovery when deciding if the stock is worth the price. Now, jumping back into the revenues by geography, most of the Canadian revenue growth was in fact organic, so there's not much to pick through there. But on the US side, things are a bit of a mess, so I'm going to try and sort through it to figure out how much of the existing business grew from Q3 of last year. Taking out the initial franchising fees, gift card breakage, acquisition-related increases, and the foreign exchange-related gains, the organic franchising revenue growth was about $1.7 million on the year, or about 3.6%, which isn't great, but it's also not that bad considering some of the headwinds that the company has been facing, which I'll get into a little bit later on. Taking a look at the system sales, which is just the total sales made by all of the restaurants under MTY banners, including both those that are franchised and the corporate-run locations. Here we get some good information on tracking the organic growth of the existing restaurant locations, defined as not having been acquired within the last 18 months. And according to the company, both Canada and the US saw mild organic growth of 4% and 2% respectively. In addition to that, we also get a bit of a peek at which brands are really pushing the growth. On the Canadian side, it looks like Toujours Mike's, Ben & Florentine, Manchouak, Thai Express, and Baton Rouge have all really been pushing the needle. And in the States, Papa Murphy's and especially Cold Stone Creamery are seeing some good growth, which is very nice to see considering that they're the only two banners that each make up over 15% of the company's total system sales. Those two are then followed by Famous Dave's, which is the third largest banner by sales, which is then followed by Wetzel's Pretzels, and then surprisingly to me, it's Village Inn, which I had no idea was larger than Baton Rouge or Sweet Frog. Anyway, moving on, let's talk about one of the big letdowns of this quarter. Last quarter, the management projected that the net locations would finally break the negative streak and yield a positive result, but unfortunately, that was not the case. Despite this quarter contributing to a record 9-month period for total location openings, the total closures were once again greater, with the net result being 5 store closures. And on the conference call, we did get a fair amount of coverage on this topic, so I'll summarize everything as concisely as possible. First off, there are some pretty serious challenges facing the franchisees, and while the federal interest rate hikes haven't been dissuading customers from turning up, they are making it harder for the franchisees to finance new locations. So that's acting as somewhat of a headwind. On top of that, the company's older concepts are getting a bit dated, and they're in need of rejuvenation in order to achieve results that will benefit both MTY and the franchisees. So this issue is weighing down system sales growth, and it's also pushing franchisees of those weaker brands not to renew their leases when their contracts expire, which, according to the management, is what's causing the bulk of the closures that have been happening in recent quarters. In order to combat this, management is still working to implement the renovation and rejuvenation strategies on a brand-by-brand basis. How well that's going to go is kind of an unknown though, since this has been a challenge for MTY for quite some time. But looking forwards, there are some really positive tailwinds that should be favorable in achieving net location openings. First, the obstruction to new store openings created during the pandemic are continuing to loosen up. These include the construction and supply chain related delays that have made it challenging to complete store builds on schedule, as well as the backlog of inspection requests for stores that would otherwise be ready to begin operating. So we should start to see the locations that are in progress start flowing out at a much more efficient and predictable pace over the coming quarters. In addition to that, there are even more stores under construction now, thanks largely to the strong brand quality of concepts like Cold Stone, which was noted as having very high opening success rates, and the recently acquired Wetzel's Pretzels, which was also noted as having standout franchising demand. And MTY still hasn't completed its franchising concept for Famous Dave's, which will also likely push future store growth in the medium to long term. So, according to Lefebvre, the CEO, the store pipeline is looking healthy and strong. Personally, I found that unlike the retail growth, the underperformance here on net locations seems much more understandable, and it does sound like there is reason for optimism going forwards. So, no demerits here, but I will be paying close attention in future quarters to make sure that these excuses are valid and that the management will deliver on their promises of store growth. Next, let's take a look at the operating expenses, which, on the whole, did grow faster than the revenues. But almost all of this was because of the large number of corporate stores taken on from the recent acquisition. If we dial in on the specific operating segments, things were actually quite a bit more positive. In Canada, franchise operating expenses decreased by 7% despite the 3% growth in revenues. Meanwhile, food processing and distribution expenses grew at roughly the same rate as the segmented revenues. Then, on the US side, franchise revenue growth outpaced expense growth by 4%. So it's nice to see that those segments are increasing their margins. Now let's get into the real important stuff. How much profit did the company make over the quarter? The answer is that, as I expected, it was in fact a record quarter for free cash flows per share, coming in at $1.77. Now, personally, I was expecting something a little closer to the $2 mark, but I definitely wouldn't consider this result a disappointment, especially since we have Papa Murphy's strongest quarter coming up, followed by Wetzel's Pretzels' strongest quarter. So, if anything, these recent acquisitions are set to make future cash flow generation a little stronger and a little less lumpy. Noting that, this record free cash flow growth was not due to an increase in the business's operating activities, since cash flows from operations were actually lower this quarter than when compared to Q2. Instead, this quarter-over-quarter growth came from the reduction in capital expenditures. See, last quarter, CapEx reduced the free cash flows by about $11 million. But this quarter that reduction shrank to only $8 million. So this was a promise that the management made good on, and they expect that the future capital expenditures will continue declining back down to more normal levels, especially next quarter when their building obligations pursuant to the acquisitions have completed. On top of that, the management anticipates that there will be no major capital expenditures for next year. So even though next quarter is supposed to be a bit slower in terms of operating performance, we may still see strong free cash flow growth due to the lowered capex numbers. Plus, if you remember from a couple quarters ago, the plan upon completion of these locations that are creating the higher capital expenditures is to sell them off as franchises. So we might see a nice little one-time bump in the net income if everything lines up in Q4. Now that we know how much cash flow was received, let's check up on the liquidity of the company. And as you can see here, the company is holding $54.3 million in cash, and the company has $128 million left available to be drawn from the revolving credit facility, meaning that the company has access to about $180 million total dollars if needed. Meanwhile, MTY has drawn a total of $770 million from their revolving credit facility, and this is debt that interest is owed on, and interest expenses are not factored into the free cash flows. So let's take a look at the debt situation. And as you might be able to tell, there's a lot of it, with the majority of that being the previously mentioned $770 million drawn from the revolver. As for the interest that's owed on this debt, these numbers, while still high, are actually coming down quite nicely, as you can see in this comparison to last quarter's projected interest payments, especially as they pertain to the 24 to 36 month figure. This lower interest expense is in large part due to the management's ability to buckle down and focus on slashing away at the debt load. As we can see here, just like when the debt levels had mounted during COVID, quarter after quarter the management is again cutting down the debt at a rapid pace, this time paying off over $26 million of long-term debt. And the speed at which the debt is being cut down is projected to accelerate as MTY's business grows and as interest expenses are reduced, allowing more cash to be allocated to the debt pile. But that's not the only reason. According to the management, the interest rate swaps that I covered in my Q1 video are saving MTY over $600,000 in interest expenses per month. Plus, the interest owed on the credit facility is also pegged to the company's debt to EBITDA levels. Now, I don't generally talk about EBITDA, so for anyone who doesn't know, it stands for earnings before interest, taxes, depreciation, and amortization. And it's just an alternative way of measuring how the underlying business is performing. But I don't generally like to use EBITDA because I find that in the majority of cases, capital expenditures used to cover the cost of a depreciated asset is necessary for the business to function. So it doesn't make sense to eliminate that line item when trying to understand how much the business is able to earn. Regardless of how I feel about the EBITDA metric, the interest rates on MTY's debt are pegged to the company's debt to EBITDA ratio. So similar to how the banks would be more likely to give you a better rate on a loan if you earn more money, have collateral to put up, or have a strong history of regularly paying your interest, MTY's revolving credit facility also has something like this in place, where the lower the company's debt to EBITDA ratio is, the lower the interest rate will be. So when the company's debt pile falls below a certain range relative to the company's earnings before interest, tax, depreciation, and amortization, the interest rate owed on the debt will also fall. The example given on the conference call was that when the owed debt is below 2.5 times the company's EBITDA, the company will save a few basis points on the interest rates that they owe. So this is essentially an incentive to carry more moderate debt levels that are more likely to be paid even if something unexpected happens. So over time, this should also play a part in accelerating the debt repayment as lower debt to EBITDA ranges are hit, unlocking lower and lower interest rates. With the management being heavily focused on allocating capital to reducing debt, it shouldn't come as any surprise that there were once again no buybacks done within the quarter. There also was no dividend increase this quarter, which came as a bit of a surprise to me, even though it definitely should not have. And this wasn't because MTY decided they aren't going to be raising the dividend this year. No, it was because I made a comically dumb mistake when looking at MTY's dividend payout history. And somehow I managed to come to the conclusion that we should expect MTY to raise their dividend this quarter rather than next quarter, even though the chart clearly shows that there have only been 3 payouts in the current level and that the dividend hike happened in last February, not in last November. So despite all of that evidence pointing to a Q4 raise, my discussion about a Q3 dividend hike still managed to make it into my video recapping last month's portfolio performance. So not exactly my proudest or brightest moment there, but I still hold on to the same opinions regarding the potential future raise. It's just that it should be expected next quarter instead. So a bit of an embarrassing mistake there, but that's bound to happen from time to time, and while I can't promise that I'll catch all of them, I can promise to continue correcting them when I do realize that mistakes have been made. So my apologies for that. Now let's move on and conclude the report with the future outlook. And this section is almost word for word identical with last quarter's. Labor challenges have continued but are improving, and the business is still remaining strong and customers are still showing a desire to eat out. So MTY hasn't seen any signs of the predicted recession, and the management is still prioritizing their debt repayments over other uses of capital. So not much new there, but we did get a few little tidbits of new information on the conference call. First, we learned that deal flow is looking quite weak at the moment, with very few restaurant brands looking to be sold in the current depreciated market with high interest rates. And that might be a good thing for a while, since there won't be any temptations for the management to bite off another massive chunk of debt for another big acquisition. Lastly, an update on the recently acquired corporate stores from the Barbecue Holdings acquisition. The CEO once again confirmed that he is not looking to divest the majority of the corporate locations, since he doesn't think that it would be sensible or beneficial to shareholders to do so. That said, he also stated with conviction that there will be a few locations sold off here and there where it makes sense, and it sounded like he had a beat on the underperforming locations and that they will be sold off in the near to medium term. And that was the quarter. So what did I think? Well, I expected that the quarter would be an exceptional one, but instead it turned out just to be a good quarter. Profits hit record highs on account of lowered capex. The management missed on net openings, but it was very close and they are set up for success on that front in the coming quarters. The debts and interest expenses continue to be driven down, so by all tangible accounts, the company looks better than it did last quarter. Plus, the company's top banners are poised to continue seeing franchise growth. And remember that I'm completely discounting any growth that comes from the release of the new retail products that will likely be under the Wetzel's Pretzels, Famous Dave's, and Village Inn brands, as well as any growth that's coming from the more accessible Famous Dave's franchise concept that's still in the works, since we don't really have any proof of concept yet. But in reality, we probably will see at least a little bit of growth coming out of these areas as well. Meanwhile, the company is sold off to a new 52-week low, which is a price that hasn't been seen since before the acquisition, back when the company had more shares outstanding and was earning about 30% less in free cash flows during the last 2 comparable quarters. Now, interest rates have risen considerably, with the 30-year Canadian discount rate approaching 4%. But even still, post-acquisition, MTY's price to free cash flow is likely sitting somewhere around 7.5 to 8, which means that even if the company's earnings were only to keep up with the rate of inflation, we'd be getting a rate of return in the ballpark of 9.5%. Unfortunately, because of how new the acquisitions are, we don't have an organic free cash flow growth rate that we can attribute to a large portion of MTY's business. Plus, the temporary capex in recent quarters have made the free cash flow growth look worse than it actually has been. That said, there's also been a lot of debt added to fund the recent acquisitions, and there are meaningful interest expenses that have to be factored in. Even still, I think that if we can fairly assume moderate growth of 3 to 4% after inflation, a multiple re-rating would be in order somewhere between 10 and 12 times free cash flows. Now, keep in mind that MTY has historically been able to achieve high margins thanks to the low-cost franchising model and the quality of its brands. But those margins have not been hitting shareholders since the return on capital has been far below the profit margins. This means that even though the company has usually been earning about a 20% free cash flow margin, the majority of those earnings are being retained by the management and used to grow the business. Unfortunately, the recent track record for the utilization of these retained earnings has not been ideal. See, even though the profit margins have been around 20%, shareholders are actually only getting 5 to 10% instead. This is because the management has been reinvesting the majority of our high margin profits into lower margin ventures. This is not what shareholders want to see, especially since debt has also been used to make more of these ventures. Put simply, the ventures haven't been performing as well as they had prior to 2015. Now, to be fair to the current management, we are looking at a short time period which did include a pandemic that caused all sorts of anomalies. So it is still very possible that the recent ventures will turn out quite well, and I do have high hopes for them. But even if the returns are in line with the retained capital over the past few years, the business itself is still really strong, and capital allocation is easy to turn around, especially when there's a high margin business available for purchase at less than 8 times free cash flow. This is partly why I criticized MTY in the past when they announced that they would be buying barbecue holdings at a price to free cash flow of 21 times. Instead, I thought it made more sense for the company to repurchase its own shares at a much lower free cash flow multiple. Now, I'm still open to the idea of being wrong on that one, especially if the franchising model takes off for Famous Dave's, but I think it's probably less certain that they'd be able to achieve the similar rate of return for barbecue holdings at the price point paid when the option to repurchase their own shares at such an obviously cheap multiple was available. Digressing back to what I said earlier, even if the acquisitions don't do well, as long as the management just decides to repurchase shares after cleaning up the balance sheet a bit, we'd likely see an astronomical rise in share price since the business would not only be achieving that 20% free cash flow multiple for shareholders, it would also be getting to reinvest into itself at a suppressed earnings multiple, such that every dollar invested at current levels would double every 4 years, in which case a huge multiple rewrite on the stock price would be necessary. Of course, this would require management to get on board with repurchasing rather than acquiring. And again, it also assumes that the long-run performance of the acquisitions will create inferior results to repurchasing shares, which I'm not 100% convinced of as of yet. Now, it also assumes that the business will continue to perform at similar levels in the coming years as it has in the past. And again, this is not guaranteed to happen. I suspect that it will, but over the coming years, we'll find out for sure. And in the meantime, I'm pretty happy with the risk-reward scenario, such that I've recently been buying shares. So for the purpose of full disclosure, of course, I am a shareholder in MTY in multiple of my accounts. Most recently, I built up MTY into my largest position within my TFSA at TD. And MTY also makes up my third largest position in my Canadian cash account, also at TD. Finally, MTY makes up my second largest position within my Wealthsimple Canadian stock portfolio, where I invest $100 of real money every month into Canadian stocks and track the progress on the channel. So, because of my ownership stake in the company, my interpretations of events may be biased, and while I do attempt to combat these biases at every turn, it is possible that some may find their way into my coverage. Also, I am not a financial advisor, and my opinions should not be confused with facts. It is very possible that my assumptions are incorrect, so it is of the utmost importance that you put the time and effort into doing your own research and coming to your own conclusions using primary sources before making any investment decisions. Again, I am not a financial advisor, and this video is not financial advice. I made this video for educational purposes and to highlight my own opinions. This video should only be relied upon for inspiration to do further research into the company outlined. After all, I'm just a Canadian who likes to invest and share what I've learned with others. I hope that you found something of value in this video, and if you have, then please consider sharing it with others. Thanks for watching all the way to the end, and enjoy the rest of your day.